that perspective. What you want to keep your eye out on, from what Kunal said, is the Nifty IT index. If you continue to see a recovery there, it looks like a very healthy bounce. But let me bring on board Sanjeev Prasad, MD and co-head, Kotak Institutional Equities, and there's rarely a better person at this point to kind of contextualize everything that's happening and give us a perspective of how Indian markets are playing out. Sanjeev, great having you. Hi, this is Harsha. Let me first start off by trying to get a sense from you. Where are we at, Sanjeev? There's uncertainty in the global marketplace, and with regard to West Asia, of course, that creates a bit of a drag globally as well in terms of growth, India growth as well. And India valuations came off, but we've seen a decent bounce. So where are we at right now? How do you contextualize this?
The issue is currently we're grappling with a whole host of uncertainty, especially with respect to the West Asia war. And it has deep ramifications for Indian economy and by extension, the earnings in the market. The challenge over here is how do you get your head around what are the possibilities out here? Now, if you look at the daily news flow cycle is not helping. I mean, one day you have some positive news around possible resolution of the crisis. The next day you have some other news, and the market is behaving accordingly. So in a way, you're reacting to short-term news or expectations, and there's no direction over here. That's the whole problem. If you look at it from a macroeconomic perspective, unfortunately, from India's perspective, we are only looking at two scenarios now: bad scenario and an ugly scenario. And what I mean by that is, if you see a reasonably quick resolution of the West Asia crisis, or the Strait of Hormuz reopens, or prices start to normalize over a period of time, even in that case, the macroeconomic situation will still be under some pressure. I mean, if you take, let's say, an average $85 a barrel crude price for the financial year 2027, which is much higher than what we saw before the war, you're still looking at a current account deficit of around 2% of GDP, a negative BOP of probably about $50 billion or so, which means pressure on the rupee. Fiscal deficit, manageable, that may be the government budget number, but with upside risk. Inflation could be in the range of 4.5% to 5%, higher than what was the case or expectation before the war, but still manageable. But if you look at the more adverse scenario, which is looking at, let's say, continuation of the war for longer, then, in a way, all bets are off. I mean, for example, if you take $100 a barrel crude price average for FY 2027, current account will, go down to somewhere about 2.5% current account deficit, that is. BOP will be $80-90% negative, more pressure on the rupee. And more worryingly, you also start seeing pressure on the other macro parameter, which is fiscal deficit could grow past 4.5% for sure. Inflation would probably more in the range of 5.5% plus minus, assuming the government at some point in time decides to raise diesel prices and gasoline prices. No signs of that as of now, but if this continues, the options get limited, right? Either the government absorbs this on its risk, which means a lot more pressure on the fiscal deficit and bond yields, or some of it gets passed on the consumer, which means high inflation. So that is our challenge over here. We are just looking at very different outcomes based on what happens. And accordingly, the market will respond. I mean, as of now, the market seems to be of the view that things will get resolved quickly. Or at least until 2 days back, I would assume that was expectation. With every passing day of no resolution, market has started to drift down a little bit, I would say. And unfortunately, the results are not helping, especially for the IT company. The rest of the earnings are actually pretty decent, I would say, for now. But if this continues for longer, then people will also start building earning downgrades, given the adverse impact of the war, lower GDP growth, higher raw material prices, weaker margins, and so on and so forth.
Sanjeev, in this entire scenario, you spoke about the fact that IT numbers were below expectation, rest were decent. How are you penciling in FY 27 earnings growth in that sense?
As I said, it's a bit tricky as of now. So as of now, we are still working with a base case scenario that this West Asia crisis will probably come to an end of April, mid of May. In terms of the actual conflict, obviously, the whole agreement issue, etc., will take longer, and oil prices start to normalize over a period of time. If that is the situation we're looking at, maybe June quarter will not look very good given higher raw material prices, etc. But hopefully things start to get better going forward. The tricky thing about India's earnings is it is in a way somewhat disconnected with the economy. And what I mean by that is a lot of India's earnings, especially if you look at the large cap names, comes from sectors which may not have directly much to do with the economy, more with the global economy, or are, let's say of global commodities, etc., or of regulated nature. And we have done some math over here. So if you look at Nifty 50 index and the composition of that, about 50% of the earnings actually come from sectors which, even if the domestic economy doesn't do well, probably there's not much impact on earnings. Oil and gas itself is about 20%. Look at coal, ONGC, Reliance, which are in the Nifty 50. They account for 20% of India's of Nifty 50's profits. IT is another 12-13%. Then you have, if you add up telecom, which is 4%, again, not that much dependent on the economy. Electric utilities, which are regulated, NTPC, Power Grid, another 4%. Then you have pharma, etc. You come to about 50, and metals, of course. That's about 5-6% of profits. It comes to about 50%. Then you have the lenders, which are the banks and the NBFCs. That's another 1/3. And here it starts to become a bit tricky. I mean, a short-lived conflict, a quarter or so of disruption. I would assume there's not much impact as far as the credit cost of the banks are concerned, or even the loan growth is concerned. But if the war prolongs for long, then obviously we'll have to start building in maybe a scenario of somewhat higher credit costs. And if you look at the rest of the earnings, which is about 60-70% or 1/6 of the Nifty 50 earnings, those are the more economically sensitive sectors. We keep aside the banks and the NBFCs out of that for now. And these are, entities which consume oil and gas directly, or consume some derivatives of oil and gas. And that's where things start to become a bit tricky, because with higher prices or lack of availability, margins could come under pressure. The volumes and margins both would come under pressure, and this problem becomes non-linear as time goes on. So let's see for now. So we are still penciling in 80% growth for the Nifty 50 profits for FY 2027. So far, we're holding on to that. As explained, it's more to do with the composition of India's earnings. But if this prolongs, then of course, we'll have to probably bring down earning numbers for the domestic part of the earning basket, so some roughly 50%. We'll have to see, how that needs to be tweaked down.
Sandeep, you look at oil and gas very closely. How do you look at especially the oil to chemicals or petchem? Because you have the big boy Reliance also coming out with earnings today. How do you look at the entire sector, not just the upstream companies, but from a petchem and the downstream companies?
Well, I don't look at it that closely now. But see that some of the things are obvious, right? The downstream oil companies, particularly the government OMCs, assuming the government does not allow a price increase for the next few weeks, and the losses start to increase quite rapidly. So at some point in time, the government will have to take some action, either in terms of raising prices or in terms of cutting taxes, which has, of course, fiscal and tax implications. The rest of the stuff all depends, what is the duration and magnitude to some extent of the conflict, in terms of how long does the war continue, how long do the availability of oil and gas remain disrupted, and so on and so forth. So it's a negative for sure, but how much negative, only time will tell, because some of the downstream companies are now struggling with lack of availability of raw materials or fuel. Some of them had to cut production, particularly let's say the ceramic type industries. 1-2 quarters they can manage, but if it's continues, obviously, you have balance sheet implications also at some point in time. Then you have, a funny situation, I wouldn't say funny, but an odd situation, I should say, of, packaging getting affected. Now, some of the companies can continue to produce, but if packaging not available, how do you sell in that case? So all sorts of, second and third order derivative negative implications start coming in. So all I can say is, hope and pray that this thing gets over quickly. You have normalization in terms of at least availability of oil and gas. Pricing is still something which you can manage, but if you don't have oil and gas available, it's a big issue. Most countries, if you look at globally, are sitting on some amount inventory, but once that inventory starts to to decline, assuming the oil and gas situation, supply from the Middle East does not normalize, then you have bigger challenges. Then crude prices, oil, gas prices will start moving up a lot more compared to whatever the market is assuming as of now. If you look at the futures market for oil, it's all building in a nice normalization in oil and gas prices in 6 months' time. I mean, I hope that's the case, but if this prolonged, then clearly you'll have to start building much higher prices for longer, which has its own negative implication for earnings of the entire downstream, pack.
Sanjeev, I'm trying to get a tilt of what pockets of the market you're most worried about. First, large versus mid cap, give us a sense, valuations versus the kind of risks we're seeing, and sectors as well. If you can just touch upon that, who will be the most impacted, and what is it that at this point you would be cautious on?
Yeah, I won't go by sectors. I think you'll have to, sorry, I won't go by caps. You should look at probably sectors and stocks, because anything which uses oil and gas as a raw material or derivatives of oil and gas, as a raw material clearly has challenges. So one is availability, the second is pricing. And then you have, as I said, let's say even consumer staple companies, if you don't have packaging available, some volumes will get impacted. I'm hearing about, prices of glass, etc., going up significantly, which has implications for, let's say, the beverage companies. Aluminum prices have gone up a lot, which has again implications for beverage companies. So it's all, messed up in the sense, I mean, it's obvious that some of the sectors will have, more indirect negative impact, which is the OMCs, aviation, which are obviously, the ones who consume large amounts of or use this as raw materials. After that, it's all nuanced depending on A, the availability, B, the market structure, C, the competitive dynamics, and so on and so forth, how much you can absorb, how much can be passed on, and so on and so forth.
Sanjeev, you mentioned about the fact that IT numbers have been decent, but within IT pack, do you see still there's room for a higher valuation for these tier 2 or mid-rank IT companies?
No, I didn't say the IT companies are decent. I said the rest of the companies have reported decent numbers, So IT is clearly just disappointed here, and we don't even know where the bottom is in terms of, the medium-term revenue projections which analysts are trying to build in, assuming some sort of a negative impact of AI, whatever 3-5% inflation, whatever companies are talking about now, whether that is it or there's more to come, very hard to say. So obviously we're all grappling with large amount of uncertainty over here. What's the worst case situation? Very hard to say. Now, whether the valuations have factored all that in, I don't know, because as of now, it looks like everybody is still working with low single digit to mid single digit top line growth for the IT companies in the short term to medium term, and with some pickup as we go along towards FY29, FY30. Very hard, to at least for me to get my head around all this. The other challenge is how much of this is priced in. If I look at multiples of at least a tier 1 company, they're similar or maybe only slightly lower compared to where they were before the pandemic, when they were theoretically growing much faster compared to what they can grow now, looks like. So is it, a good multiple to look at? Obviously, I've seen decent correction multiples of this company, right? For example, Infosys, which used to be at, let's say, 22 times March 25, in March 22, March 25 plus 20 times 1 year forward. It's come down to about 16. So it looks like a healthy correction. Looks like some of the, I would say, worst case situation priced in. But if I look at where it used to trade before the COVID pandemic, it was same multiple, 15 to 17, 18 times. If I look at TCS as an example, yeah, it's come down to about 16 times, similar to when Infosys are forward. But it's not very different from what it used to trade before the pandemic, 17, 18 times.
Right.
With a large amount of uncertainty with respect to the top line itself.
Right. Sanjeev, always great chatting with you. Always short on time when we're speaking with you, but thank you so much for coming in and making time and speaking with us. Okay, viewers, what we'll do is dive into a very quick break, come back, talk about sugar. Let's try and understand what's playing out over there. Stay with us.